Hello guys. In this video I will try just to explain something very tricky, and a lot of people they don't understand how the price move. Okay, if I, for example, I want to buy 100 shares of a stock, okay, any kind of stock, I am a buyer, okay, and there is a seller who wants to sell 100 shares of a given stock. Okay, now if I buy and he sells, how the stock price move? And it's all like this, like matching buyers with sellers. Okay, this is what the market do. But how the market, the price goes up and how it goes down since it's equal? Okay, this is just a misconception. It's just, the thing is you don't understand a basic economic thing that everybody knows. Now they know it, but in practice they have problem with it. So what is it? It's called supply and demand. What does it mean? It means that when there are a lot of sellers in the market, a lot of sellers, and this is called, most of when we have big sellers, they want to sell a big chunk of their stake of stock. For example, a mutual fund who has, for example, 50 million shares of a stock, but he wants today to get rid of 10 million shares. Now this is what we call supply. It's a lot of supply to that stock. Now if there is a big supply, we don't find a lot of buyers for this stake because it's too much. Okay, now when we have a lot of shares in the market, the price goes down, and this is what we call supply in economy, because the demand is so little. For example, there are, like, let's say 10 million shares will be sold today. But the problem is that the people who are in the market can buy only 1 million shares. Now what will happen to the 9 million that the sellers don't sell? Here, when the market, because that price they want to sell, they can't reach it, they should go down. For example, I will just give you an example. If you want to sell a car, okay, it's an old car. Let's say you put $2,000, but you put it in the market for many weeks in Craigslist or in Angie's List or you go to an auction and you want to sell it, but that price, no one wants it. Okay, there are some buyers who want your car with 1,000. Now, are you willing to sell your car at 1,000? If you are selling at 1,000, what does it mean? It means you drop the price of your car. This is what the market do. Where there is a lot of buyers and we have a lot of sellers, what did happen in the market? The sellers, especially when they sell with limit order, they say, I want to sell this stock now at $50. But since there is no one who wants to buy at 50, but there is someone who is willing to buy your stock share at 49.50 cents. Now, if you do what we call a market order, you say to the market, I want to sell my shares with whatever price is there in the market, just sell it. Now, if you say market order, you will see that the price, you will not get $50, but you get, let's say, $49.90 now, and then 80, and then maybe 50, depending on the market rush. If there is a big sell-off, okay, there are a lot of sellers, but there is no buyers, the stock price will go down very, very quick. And other guys help the price to go more down are the short sellers. Okay? They borrow other shares of other people from the broker and they sell it. So the more the price goes down, the more they get profit. But the investors, when they sell and they want to sell in that day, they will begin to lose money. Let's say I have given you the example of Twitter. The stock was $74.73. But right now, if someone holds his, let's say he has 1,000 shares last year or the other year, and the stock, and he has been making money, and at $74.73 he doesn't want to sell. He say, why I should sell? Maybe from $74.73 the stock will go to 100 or 200. Okay, he's an investor. He looks far away, and he wants to invest in this company, let's say Twitter. But the problem is that each week, each month, the price has gone down because the people who wants to sell at that price, they don't find that price. Let's say 70. They don't find 70. So they put it less. 69, 50. They don't find. So they go lower. And this is what makes the price goes down. Okay, let's go to the reverse. Why the stock price go up? Since we match sellers with buyers. So the thing that most of the beginners they don't understand is that there is no matching. Okay, there is no matching. Not everyone who wants to sell, he will get that price he wants to sell with. And no one who wants to buy, he wants to find the price that he wants. For example, I gave you just a very simple example of a loser like Twitter. I have given you the example. Let's say I give you a winner like Facebook. Facebook, 3 years ago, the lowest price was $17.55. Now, can you buy Facebook at that price? No. The price now is, I think, is $101 or $2. Okay, for today. Now, let's say tomorrow you find that the stock has gone more. Let's say it becomes $105. And you want to buy. So you buy it, but you buy it more expensive. Now, why you buy it more expensive? Because there are not a lot of people who want to sell. That's why we have a lot of buyers. They want to buy this stock because they heard the news or they read an article or someone recommend Facebook or something. That's why the people don't want to sell. There are few sellers, but the buyers, there are a lot of buyers. And this is called the demand in economy. When the demand of something is very high, the price will go up. Okay? Because the guy, he has a stock, he has, let's say, 10,000 shares of Facebook at $100. He doesn't want to sell right now. He thinks that the stock will go to $110, $120, $150 or $200. So why he wants to sell? So he doesn't sell, and almost all the people, they don't sell. Okay? So this is the mechanic of the price. how it goes up, how it goes down, is just because of a simple thing in economy, which is called supply and demand. Okay, this happens also for coins. If you are into coins, or you understand coins value, you find that there are some coins that are too expensive. Why? Because they are rare. You don't find them. That's why people, because these coins are rare, the price will go higher and higher and higher and higher, because the people, they don't find. Okay? Now, if the coins that are not searched for in the market, even if it is old, you find it has really not that value. For example, the wheat cents below 1958. Okay, from 1958 down, they are called wheat cents. Okay, you find sometimes you find 1 cent, you can buy it with 4 cents or 3 cents or 5 cents or 6 cents. So it's not that big deal. But there are 1 cent, if you can find it, like for example, 1944 steel cent, if you find it, it's nearly $100,000. How can you say a cent is $100,000? It's the market. Because the people, they don't find that many. That's why it is so expensive. If you find one, you will have this kind of amount of money. But since the people, they don't find, so you find others that are cheap. Okay? Now, hope with these 3 examples of stocks, of cars, selling and buying cars, and this example of coins, you have an idea why the price goes up and why the price goes down, and what's the mechanic that goes through this. Okay, thank you very much. If you have any doubt or still you have problem understand this, please comment below or send me a private message at my email is always on the top of the description. Send me an email. I can give you more examples to help you. I'm here to help. Please ask more questions and I try to answer and to help you out as usual. Thank you very much and have a nice day.